Dear friends, welcome to the monthly outlook on markets. While Indian markets corrected sharply during the month, most of the global markets have been relatively stable. Let us delve into few important questions that are emerging as a concern for investors, starting with what are the reasons for this correction? We believe confluence of factors have contributed to this. Few among them include uncertainty in global trade, slowdown in Indian macro, and slow recovery in India in corporate profit growth. Let us start with uncertainty in global trade. In his second term, President Donald Trump has intensified his protectionist trade policies, implementing significant tariffs aimed at reshaping the United States' economic relationships. Trump has also talked of reciprocal tariffs. India exported nearly $74 billion worth of goods to the United States, with key sectors being pearls, gems, pharmaceuticals, and petrochemicals. Trump has also declared his intention of applying a 25% import tariffs on automobiles, pharmaceuticals, and chips. This could also have major ramifications for Indian pharma and auto ancillary space, and could also hit the budding chip manufacturing space. The tariff talk under Trump administration has triggered volatility in global currency markets, with emerging market currencies bearing the brunt of trade-related uncertainties. US dollar strengthened as investors sought safe haven assets amidst escalating trade tensions. We do not believe that the final outcome will be as disruptive. Supply chains are built over a long period. Changes, if any, will also be gradual. India, due to its intellectual manpower and low-cost manufacturing, has advantages in multiple sectors, including gems and jewelry, pharmaceutical, chemicals, automobiles, and many more spaces. Let us now get into the second important aspect, which is slowdown in Indian macro. In the quarter 2 of fiscal year 25, India's GDP growth declined to 5.4% YOY, from close to about 7% levels that we have been maintaining. A major slowdown in government spending in the first 8 months of the current financial year has been the major contributor. Also, the subdued consumption growth continued. The FY25-FY26 budget has raised worries regarding the growth trajectory of government capital expenditure. Budget also took a more balanced approach regarding consumption and capital expenditure spends. That said, we believe activity levels are gradually picking up. After the lull for the first 8 months, central government spending picked up in December 24. It has grown by about 2% fiscal year till date, April to December 24, versus a decline of about 12% until November 24. Likewise, we have seen some improvement in the pace of spending by large states in India. Their spend, which was declining at about 5% until November 24, has also shown a growth of about 4% until December 24. Moreover, there is a reorientation of sectors from roads and railways to power, urban infrastructure, ports and water due to the higher requirement of infrastructure in these areas. Thus, we see the GDP growth picking up in the coming quarters. Another important aspect has been about slow recovery in India in corporate profit growth. Overall, BSE 500 stocks reported earnings growth of about 7 to 8% year on year. This would have been double-digit growth but for the commodity-oriented sectors, where we saw close to about 3% decline in earnings. Small caps in the BSE 500 index actually saw a decline in earnings for the second quarter in a row. This clearly shows that time to play small cap is when economic activity is accelerating, and be very selective in small cap space when the economic activity is slowing down. small cap space has already seen the brunt in terms of stock prices. In line with the pickup in GDP growth, earnings growth should pick up as well over period. Cement demand is picking up, prices have stabilized. A pickup in government capital expenditure should help the infrastructure companies. Reduction of taxes for the middle class could lead to a demand pickup in retail, quick commerce, online food delivery, quick service restaurants, hotels, real estate, and airlines. And also, we believe we should see volumes of automobiles and consumer durable demand improving. Now let us move to the second question that is in the minds of investor, and it is about capital expenditure. Is the capex cycle really losing steam? While the activity has been slow, it should pick up going forward. We continue to believe manufacturing in India, for India, and for the world is a long-term opportunity. Sectors like power, energy transition, electronic manufacturing, infrastructure investments, and many more should continue to see investment activity going forward. Another question is the urban and rural consumption demand improving? In the last result season, most of the corporates have spoken about improving rural demand. While urban demand has continued to remain muted, corporates expect urban demand to gradually recover due to lower inflationary pressures. Moreover, the rate cut and more expected, and the tax swaps announced in the recently concluded union budget could aid further demand. We have seen sharp FII outflows in last few months. This begets a question that will FII equity outflow persist? While it is always difficult to predict short-term behavior, India has already witnessed a large outflow. In the last 4.5 months, FIIs have already withdrawn more than $20 billion from the Indian market. FII ownership in India is now at close to about 16%, a decadal low. We believe outflows should recede as Indian markets valuation are relatively more reasonable, and India's economic and profit growth should improve. That will be driven by fiscal and monetary impulses. In this scenario, what are the sectors to focus on at current juncture? In an environment of slow earnings growth, it is important to focus on bottom-up ideation rather than a top-down approach. We believe that a select businesses in discretionary consumption, manufacturing, and pharmaceuticals should do well. Consumption businesses should benefit from moderate inflation and continued income growth. Government tax cuts and lower interest rates should also help. Manufacturing sector is expected to do well, driven by redrawing of global supply chain lines, a focus on import substitution, and the rebuilding or creating infrastructure in India and globally. Businesses operating in electronic manufacturing, energy transition, circular economy, and semiconductors are expected to benefit. Pharmaceutical. The focus has to be on the entire ecosystem, including domestic branded space, US generic, CDMO, hospitals, consumables, and many more. And lastly, what should be the investment style in this environment? At ASK, we believe we are back to 101 of investing. While profit growth for India Incorporate should improve going forward, we may not be back to the 20% growth seen in the last few years. As growth becomes relatively more difficult to come by, markets should start to see valuation polarization in those businesses that can execute well. And also, we need to keep a very mindful eye on capital efficiency. Markets should move from pure P&L to P&L and balance sheet and cash flows, as money raising from markets may get difficult. Growth has to be more self-funded. At ASK, we have always focused on businesses that have secular opportunities, run by management that have execution prowess and have the ability to show value-adding growth. This growth has to be backed by superior capital efficiency across cycles. The quality of businesses and management continues to remain a very strong focus of our investment philosophy. We continue to remain steadfast focused on businesses that can stand test of time. Happy investing. Thank you.